Hi, Brian Shannon here from alphatrends.net. Today is Monday, June 28th, 2010. Let's take a look at the S&P 500. As we noted last week, the S&P 500 got below that 200-day moving average and fell below the 5-day moving average at the same time when it lost that support at the 111 level. From there, we did see a pretty strong sell-off, and we still see this pattern of lower highs, and we have a slightly higher low here today, but I don't think that means it's time to get involved in this market on the long side. We still have a declining 5-day moving average, and when the market is below that declining 5-day moving average, the only longs I think that you want to look at are on a very short term, that is day trade basis. So if we look at, for instance, a 30-minute time frame, we can get a little bit better perspective of that 5-day moving average and being long for swing trades basically above and short below. That doesn't mean it's a timing signal, as moving averages aren't meant to be that. But what we want to do is we want to look at this market and say, well, the 5-day moving average is declining. It's generally guilty till proven innocent. We have to be prepared for anything, of course. There is the possibility that maybe this market gaps up beyond that level, at about 108.70, similar to the way it did over here, and then we can build a rally from that level. But to me, it doesn't seem likely, and what's likely is what's more important to consider. We are still in a downtrend. We fell short of that declining 50-day moving average last week. We've got a declining 10 and 20-day moving average, and this market's just kind of holding on here on very light volume. Since the beginning of June, the average daily volume has been decreasing. That's a 20-day moving average of volume in the S&P 500, and we saw on Monday that that volume was even lighter. One of the lightest days since we had seen back in April here. So I think that's kind of indicative of a summer market, and looking for the market looking forward to a 3-day weekend as well. So we are stuck below that 200-day moving average. We've got all these other moving averages declining. It seems likely to me that this market would be more likely to come down and test the 105 area than it would be to rally up. However, we always have to be aware of all possible scenarios, and if the market were somehow to maybe gap up or just get above the recent resistance at about 108.60 and hold above there, then we have to consider the possibility that maybe it's going to run up for a test of 111. But again, that's not what seems likely. Going to the bigger picture, that is the weekly time frame, we've been discussing a couple options here. That is either a possibility of a head and shoulders pattern developing, or that the market was going to kind of do what it did after this decline, so similar to it right here, that it was going to maybe recover and then rally up to new highs. Well, I think that the scenario that is similar to 2007 right now seems to be less likely, and that this head and shoulders pattern is really capturing a lot more people's attention. Now, the good news about the head and shoulders pattern is a lot of times the market doesn't do that textbook technical analysis. That is, sometimes we'll see a break below the neckline and then it reverses back up. That's what we'd seen on a daily chart back in here back in July of last year. Now that's on a daily chart. We hadn't seen a head and shoulders pattern here if you go back and take a look at that. But the point is, the path of least resistance really is lower. It's the market comes down a lot easier than it goes up, and we've seen increasing volume on the decline as well. So it seems as though maybe the market is just kind of biding time here before it dips a little bit lower. Again, always be open-minded to anything, but if we see these levels 106.80 in particular broken, then I think that it's likely we're headed for lower lows. We were talking last week also about the volume by price, and how that 111 area, once it was broken, that it didn't seem likely it was going to get back above there, because we had this big area of supply or this big area of volume that traded up there, and where there's volume, there's where the price action, that is, where there's price, there's memory, and that when basically we get below it, it means that there's a large group of participants who are trapped, and it acts as resistance. We were then looking at the bigger level, the next bigger level down near this 109 to 108 area, and here we are. You can see we're in this area where this is a big level, that if we break below this 107, 106.80, then we'll have all that volume up above us, which would serve, I think, to be a very strong level of resistance that would likely lead us to another test of 105. So a lot of reasons to still be very cautious on this market. There's nothing here indicating that the worst is over for this, so just remain very defensive in this environment.